keep awake while you are fresh because you have morning time.
skip yo फिर webinar
नमस्कार शेट्टी सर, सभी को नमस्कार।
नमस्कार पांडे जी। Mr. Lobo, Mr.
Yes.
Manoj Pandey is from BIMTech.
Yeah, I know Mr. Manoj. He's also my ex-colleague from LIC.
Very good, very good.
Hi, Manoj.
हाँ राहुल, मैं बात करता हूँ, मैं आपको लिंक भेजता हूँ, जिस लिंक से मैंने लॉग इन किया है। मुझे तो लिंक मिला, मैं आपको
दस रहेगा जो शाम दोपहर को बाद में क्लियर करेंगे, उनमें डिटेल देती है, बाकी इतने और भी कुछ आएगा उन द ग्रेड जितना फिर बेटर है। हाँ जी ये देखो
एक मिनट
तीन साल या 5 साल की थर्ड पार्टी जरूरी
है। 3 साल की थर्ड पार्टी, 1 साल की कंपनी। देखो वो फिर क्यों है,
हम चेक कर लीजिएगा, मैंने आपके मेल बाजार पे भेजा है।
पॉलिसी भाई है एज पर द लॉ। मैं देख रहा हूँ
सेठी सर,
Yes, sir.
चौरसिया इज फाइंडिंग सम डिफिकल्टी, तो उसका कुछ दूसरा लिंक वगैरह उनको भेजना पड़ सकता है शायद। जरा
नहीं,
राजेश को बोलिए, he can coordinate with him.
Rajesh, I
मतलब
have,
Yes, sir. Good morning, all.
Rajesh, please provide link to Mr. Rahul Chaurasia. Yes, he has come.
Okay. Okay. Done. Okay.
Thank you. Thank you very much.
Rajesh, you can
I am
also
sorry मैं
try.
आपको रिस्पॉन्ड नहीं कर पाया, उसी वक्त राहुल जी का फोन आया था. गुड टू हियर. लोबो जी नमस्ते.
Rajesh, please try with Mr. Saideva and Mr. Sani.
Hi, Anil sir. How are you doing?
All
Fine,
well, all
Rahul, long
Okay, sir. Okay.
I don't know if you remember me. We have met long time back.
Rahul's link shows the name as Manoj Pandey, Mr. Manoj Pandey, professor. You use this link.
I use Manoj Pandey Saab link. How can I change rename? Okay.
Yeah.
Rajesh, please provide the right link to Rahul so that his name appears.
Has my name changed?
Saideva ji,
Yes,
good
yes.
morning.
Good morning, very good morning.
Good morning, Sudheva sir. We're meeting for the first time. Thank you, Seti sir, for inviting me.
Yes, very good morning. And yes, I think all the co-panelists are meeting for the first time.
No, I have met Anil sir before. I don't know if he remembers me.
Yeah. we do. Being in the same industry.
In fact, his colleague Sanil, I keep interacting also.
Yeah.
I met Anil sir in his Gurgaon office long time back.
Yes, we met in 2015-16 probably.
Yeah, I mean, yes. It's
Great.
been my bad.
Mr. Lobo is a person of all India reputation, but he remains focused in South India and Western India. So Delhi and Gurgaon do not have the opportunity of his visit and meeting us. Yes.
Not particularly. You are right. Partially, post my superannuation from Mercer, my travel is to north is not virtually not there.
So probably next time you are here, sir, I can host you for a coffee along with all other panelists, sir.
Wow, that's such a nice thing. Thank you, Rahul.
I'm in Central Delhi, so I can host all of you in my office or wherever you want.
Thank you.
Let us wait for 2 minutes and then we start.
Manoj Pandey Saab, I like your background with the name. Manoj Pandey Saab, I said I like your background with the name.
You're not audible. Manoj sir, you're not audible.
Am I audible now?
You are.
Yes, please.
Yes, very much.
So that institute has given this background to all the participants to have a uniformity in the session.
Oh, is that so?
So I am keeping that because that gives a good impression.
Okay, that's nice. Okay.
Is that
From BeamTech, yeah. Same as Rahul.
Rahul using his company background.
Yeah.
But
Very good. Let's make the beginning. So, Madam Babita Sharma and myself, we are starting this webinar on behalf of PID Chamber of Commerce and Insurance Foundation of India. And the panelists, experts whom we can see on the screen are Mr. Lobo, Mr. S.K. Jain, Professor Manoj Pandey, Mr. Rahul Chaurasia, Mr. B.R. Saideva, and another is Mr. Sanjay Ahuja, who is very much from the committee which is hosting this webinar. So the first point, which is I always take whenever we are starting any webinar or seminar is that why we thought of this webinar. Because there are large number of institutions in the country, and from time to time they are organizing different programs. PID Chamber of Commerce, we are Delhi-based Chamber of Commerce, which was started in the year 1905 and has completed 118 years of existence, which is serving large population of the country because we are operating in many states and territories and all over the country. We are Apex Chamber of Commerce, which works in coordination, in association as a policy advocacy group with the government of India, its ministries, its authorities, its regulators for upliftment of the society. And the focus which we are having in PID Chamber of Commerce is on the business aspects of MSME units, which are located all over the country, and number of them number can be 1,45,000, 1,48,000. We are popular in the country for organizing thought-provoking seminars, webinars, conferences, and we have also brought some of the best knowledge papers pertaining to insurance industry. Some of our recent seminars, webinars which have been appreciated very well in the insurance industry are introduction of IFRS accounting standards in insurance industry. And we are pleased to say that the thought-provoking webinar which we had resulted in interaction with various authorities, bodies, and all that thing. And now we are informed that in 2024, in the insurance industry, IFRS standards will be introduced. We were also responsible for organizing a webinar on Bima Sugam at a time when we had started hearing from different quarters of the insurance industry that Bima Sugam idea is not taking off. But when this webinar was conducted and large number of experts participated in this, including Mr. G. Srinivasan and Professor Bijon Mishra, that Bima Sugam got due importance, and now we are told that it is being implemented. And some of the decisions have been taken by the regulator in this regard, which you must have read in the newspapers or in the media. So we can say that PID Chamber of Commerce and Insurance Foundation of India are playing a very important role in spreading the awareness of insurance in the country, which is very much required for increasing the penetration of insurance in the country. Our webinar today is on gratuity insurance, implications of Gratuity Act for directors and top management. As you will hear from the experts that this act, which was brought in 1972, is having a clear-cut mention under Section 4A of compulsory insurance. Large number of organizations do not give the importance to the gratuity or Gratuity Act, which is, one can say, is their ignorance. And our role as Chamber of Commerce is to bring to the notice of the MSMEs and other organizations that do not ignore the implications of Gratuity Act. So when I was making some study, and I found that there have been so many cases which have gone to High Court and Supreme Court of India pertaining to different aspects of Gratuity Act. And some of these cases are Indian Hume Pipe versus their workmen. And in one of the judgment, Supreme Court had said that general principle underlying a gratuity scheme is that by service over a long period, the employee is entitled to claim a certain amount as retirement benefit. So while most of the employees which we have come across have been talking of provident fund as one of the, that when I will retire, I will get provident fund, they do not talk of gratuity because they are not aware of it. Sudden closure of any company, any organization results in losses to large number of employees who do not get the gratuity benefit. And this point will emerge out as different experts will be sharing their knowledge with us. Some gratuity new rules of 2021 will also be covered by the experts. And now it is that I am leaving it to the experts to take this webinar to advanced stage. And first we are having is Mr. S.K. Jain. He's an author, he's an insurance professional, and Insurance Brokers of Association of India had the proud privilege of having him as vice president and director for 8 years, during which he brought IBI to greater heights, which we are seeing today. So he is covering with us Gratuity Act, its details, role of directors, implications of violations, and some case studies. So let us hear Mr. S.K. Jain.
Thank you, Sethi Saab.
Yes, sir.
शायद जैन साहब को होस्टिंग का वो नहीं है, मतलब he cannot share his PPT. He should be made co-host.
No, access is there, I think. Sir, just click on the share screen. I think last time you have done it.
I am doing that.
Okay, sir.
Yes, sir.
Are you able to see?
No.
I believe if somebody from the host side can actually project all the presentation, it will be easier. Otherwise, you'll have to use right screen. So somebody from the PhD Chamber of Commerce, because I believe all of us have sent our presentations to the email ID. These I have sent you mine in the morning today. So if that can be given to them, it will be easier, and then the presentation can be run. That will make things easier for all of us.
I'm sorry, I'm unable to share the screen.
So without the screen, Jain Saab, you can start speaking because you have the clarity on this subject. So naturally, you will be able to convey the whole thing.
Okay, then let me start as it is. The gratuity basically that started this. This is the old age benefit to the employees, in addition to the provident fund, ESI, leave encashment, and the gratuity. One of the old age benefit is given to the employees. For that purpose, the Gratuity Act was enacted in 1972, for which they have prescribed the minimum number of employees should be there, and the minimum service they are defined. Minimum period of service, say 5 years, they have defined in that, so that after 5 years, he can get the amount as and when he resign from the post or till his retirement, he will get all the benefits, and the formula is defined in the Gratuity Act. That is a 15 days per completed of year of service. And mostly all organizations who are employing more than 10 persons, they are eligible for the they are allowed for, they are eligible for the gratuity. But I have worked in a many private organizations. This act is misused by MSME as well as other organizations. What they do, when any employee, any worker is completing the 5 years, is about to complete the 5 years, say after 4.5 years, they will ask him to submit the resign. He will submit the resign, and they will pay he will continue the job with the salary. He will be paid, but he will not be on the road. So that break in the service. After 6 months, again he will be employed. In consideration, there is some the employer is paying some some amount to the worker, and this is very common in northern region. Especially, I have seen in Ludhiana, Baddi. These are industrial area where this is the common practice, and they are escaping, the employer are escaping the liability for the gratuity. This is the one reason how the employer is escaping the gratuity level. Now again in the new wage bill 2021, there the service record has been reduced from 5 years to 1 year, and the salary part they have taken is the 50% of salary, whatever the CTC is there, 50% should be the basic salary. On that, the gratuity amount is to be paid. That is a good thing, but it is not implemented. So again, as Mr. Sethi said, Section 4A of the Gratuity Act, the insurance is mandatory. No, it is not mandatory, because there is no notification. Because Section 4A say till the government notifies, and government is not notifying. As on date, the government has not notified after even 10 years. So it is not mandatory to implement this. Every employer has to take the insurance. Only because of the Indian Accounting Standard 15, by virtue of that, big corporate are taking the gratuity insurance. That the accounting standard also says if the employees are limited, say 10, 15, then no need to take the insurance. If they can be paid as and when their liability arises. If there are more employees, they can create their own fund. If there are more than 500 employees or 200 employees, then they can go for they have to follow the accounting standard, they can go for the insurance. While they're going to insurance, then they have to go for the actuarial valuation. As on 31st March, what is the liability and what is how much amount is payable to each worker. So liability they have to provide in the books of accounts and making the payment for the premium. And there's a panel provision also in the this Payment of Gratuity Act. If there is any employee is not given the gratuity on time, he can file a suit against the company in the labor court. It is predefined in the act. Panel provisions are there. If they are not paying, the employer still is not paying the gratuity, then that labor court can appoint a receiver, liquidator to liquidate the assets and to pay the. So the question of to file a suit against the director does not arise unless until the action is taken under the Payment of Gratuity Act. No action will be taken against for the directors under the Companies Act, because there is a provision in the Payment of Gratuity Act that provision should be invoked first. Only then it can go to the. It is because there is no provision for the directors to file suit against them. They have not paid. They can liquidate the assets. That says in the Payment of Gratuity Act. So this is my small submission on the Payment of Gratuity Act and how it has been misused in the industry, and what is the latest provision I have to explain, and rest it leads to the other that other, you can say the experts who can give their opinion. Thank you very much.
So while we are waiting for Mr. Hitesh Saini to join, and we will cover up his point later on. Now we move to Mr. Lobo, who is a consultant on retirement and employee benefits. And as he mentioned, he has been a very senior person in Mercer, and he has handled large number of corporations of this country for these aspects and all that thing. So he is telling us on understanding gratuity benefits and advantage of advance funding of the liability. So because this appears very well in his presentation, which let us see. Yes, Mr. Lobo.
Thank you, Mr. Siti. Thank you for this opportunity for both PhD Chamber of Commerce and Insurance Foundation of India. I'm very much privileged and happy to be part of this webinar. And I know there has been a lot of webinars and good, interesting subjects being conducted by these two organizations jointly. It's quite interesting and very useful projects are being, I compliment them. I will. One minute.
I think some background is coming throughout the webinar. Please mute yourself.
So as Mr. Siti said, I would be speaking on understanding the gratuity benefits, advantage of advance funding. The agenda is clear. Gratuity being a defined benefit. Let's understand the defined benefit and defined contribution plans, nature of gratuity liability. I would like to have a disclaimer. I'm not an actuary, but I understand the concepts very well, having worked with the actuarial team for a long time. Gratuity, funded versus unfunded, funding options, advantage of advance funding, and advantage of having an insurance company as a fund manager. So understanding, as Mr. Jain had already told, gratuity has got three parameters. One is 15 days salary for each year of service, and minimum 5 years eligibility. This is not applicable in case of death, and the upper limit of 20 lakhs for the taxation purpose, which is exempt from tax. So gratuity is payable in case of exit due to retirement, resignation, or unfortunate death while in service. And the formula being 15 divided by, last wages at the time of exit, 15 divided by 26, and number of years of service. Number of years of service is 6 months rounded up to the next year. The formula is very, very clear and crystal clear. However, as earlier said, the clause 4A of the Gratuity Act, when notified in 1972, as and when respective governments notify this for 4A gets operational. I think state of Andhra Pradesh way back in 2010 did introduce this, but the clarity was not there, whether it is a term insurance or a funding. Anyway, let's come to it later. Benefit of gratuity is in 2018, the limit was limited to increase to 20 lakhs. I remember when it started, it was 50,000, then it increased to 2.5, 3.5 lakhs, so on. And now it is 20 lakhs. The employer may offer more generous benefits. They can give higher rate of gratuity or without upper limit of 20 lakhs. Now the defined benefit is nothing but function of last on salary as a formula based, as the gratuity itself is an example where the last on salary into 15 by 26 and the number of years of service is taken. The benefit is known in advance. However, the cost of providing this benefit is not known to the employer. The lump sum cannot be visualized because after 25, 30 years of service, what is going to be the last on salary, nobody knows. And also there could be regulatory changes. In case of defined contribution, the contribution is as a percentage of salary, maybe 5%, 10% or 15%, whatever is accrued along with the interest, he forms the corpus to purchase an annuity. This is in case of pension. You would have heard many of your seniors or in the family members with the bank employees or public sector undertaking getting this pension benefit from the government, where it is 50% of the last on salary linked to consumer price index. And here that is the defined benefit, whereas the cost of defined contribution is known. However, the investment risk, the accumulation rate at which it grows is not known. However, the risk is on the employee. In this case, we are talking about a defined benefit plan, that is gratuity. And understanding gratuity benefit further, being a defined benefit plan, it's a final benefit on retirement exit due to resignation, retirement, or death. The formula is based on the final salary, as I already said, at the time of exit. Defined benefit plans are a promise made by the employer to the employees that there is a predetermined lump sum which is being paid on exit of the employee. Thus, under defined benefit, the amount is guaranteed, but the employer is exposed to risk associated with funding and the guarantees. Any guarantee comes at a cost, and funding rate, you never know, because the function of the last on salary liabilities keeps on increasing, and you never know what is going to be the ongoing cost of this benefit. That being the case, this uncertainties of final benefit, the ultimate cost is not known to the employer. That is the tricky situation. Defined benefit liabilities are hence need to be assessed by an actuary by way of actuarial valuation. The accounting standards do prescribe that a qualified actuary has to conduct this valuation and assess the ongoing liability for the accounting purpose. There are a number of accounting standards which has been prescribed based on the applicable accounting standard. The valuations are done. However, there is a subtle difference for the valuation for the funding purposes. Assumptions used for accounting is not completely true for what is being used for funding. If gratuity is unfunded, the provision for such liabilities are made in the books of accounts, and the company meets the cost, ongoing cost, as and when the liability occurs, as and when the employees leave the company or exit happens due to retirement or unforeseen death. So this impacts the working capital of the company and the cash flows of the company, because you cannot foresee when this liability comes. And also depends on the fortunes of the company. If company is doing well, nobody leaves. If the company is not doing well, the tendency to look around and leave. At that time, the payment of gratuity, suddenly when the company is in very bad state, payment of gratuity becomes another burden on the company. So particularly SMEs and MSMEs should take note of unfunded liabilities can add up to their miseries during the bad times of the company. Defined benefit, if it is funded, then the investment performance of the fund decides the sustainability of the promised benefits. The contributions made on a systematic ongoing basis as recommended by an actuary gives you some sort of a certainty or a vision as to what is likely to be funding year after year. And of course, the return on investment decides the sustainability of the promised benefits, because investments fund needs to be invested as per the income tax rule, guidelines are there. It needs to beat the inflation to sustain. And this also reduces your future liability to the extent fund is earns the interest. So gratuity liability, needless to say, increases exponentially as and when the various components of defining this benefit increases. For example, the wages, increase in wages, adding on one more year of service, and more so the regulatory changes. The upper limit of gratuity was suddenly increased in 2018 to 20 lakhs. The people, senior employees, will definitely cross this, and are now even some of them are crossing 20 lakhs or exceeding the limit. So these liabilities has to be valued by a qualified actuary and assessed. And what does an actuary do? Actuary makes a financial sense to the future of the company, the cash flows of the company. He enables company to take a well-informed decision on the funding and the liability. He reflects the liability, how it is sits. Quite often, olden days, I have known even the M&A deals have been broken when the huge liability of defined benefit pension was sitting in the books, which was not at all part of discussion at that time. And when you discover the huge liability sitting, it becomes a real discovery, because being a defined benefit liability. So this gives a sort of actuaries help to take a balanced view and takes interest of all the stakeholders and also the beneficiaries. On the whole, what actuaries do, I am fond of saying this, that actuarial report is a sort of a financial health checkup, which gives, when you go for a blood checkup, it gives a histopathological report, just like the actuaries give the reflect your liability and how the liabilities moves. Now, how does the actuarial liability is assessed? It is based on certain assumptions of salary escalation rate at which salary is expected to increase during the balanced work life of each of the employees. I'm saying work life until it is not today's increase. In a particular year, the salary increase may be higher. It has to be evened out over the years. What is the expected rate of salaries, escalation rate during the balanced work life? The discount rate is generally taken into bond yields of the being declared. When the bond yields vary, the liabilities vary. The attrition rate of the employees, how long the employees are likely to stay with the company, how many of them are likely to be with the company till their retirement, or what is the likelihood of mortality rate or death happening while working service. These are all various assumptions which impacts the valuation and which is required. Of course, the retirement age is another criteria. If your retirement age was 58 and you have exceeded the 58 to 60 extended, your liability may vary depending on the. Another important is the employee census data, which has the date of birth, date of joining, and also your designation, occupation. If there is an insurance cover, the occupational group also values for the term cover when it is with the insurance cover. So these wage data is informed. Second, the scale of benefit. Is it as per the Gratuity Act or more generous benefit? Companies do offer without the 5-year lock-in period. I would propose, as per the new labor laws which is going to come in, probably the 5-year clause may be reduced to 1 year, and also the wage where 50% of the total CTC, basic and DA should be at least 50% of the CTC, and the liability increases with these. The scale of benefit, if it is more generous and without upper limit, the liability increases. So actuarial liability is nothing but a defined benefit obligation of a company at a given time. I think I'm not being too technical on this. To simplify it further and deep dive a little, nature of gratuity liabilities, again, actual valuation involves projection of benefits payable into the future of each of the employees, or the dependents in case of defined benefit pension, and it is projected. Actual liability is the sum of present value of benefits of each employee, which is projected over the years till retirement and backwards discounted based on the bond yields. Assumptions are made projecting the likelihood of payout of benefits on a future date intervened by resignation, retirement, or death. The present value of benefit is again by a formula is projected value of benefit into the discount factor and the probability of payments. The assumptions going into is salary escalation, and the discount factor provides the present value of benefits and probability of employees remaining in service till retirement. So I think these two slides are a little technical. Don't worry about it. Just to tell, the defined benefit is how complicated to value. Actuaries make it simple for you and gives a better business sense of the defined benefit liability of gratuity scheme. Now, what is the advantage of funded versus unfunded? One is compliance, whether you are funded or not funded. You will have to meet the gratuity as per the Gratuity Act to pay the gratuity within 30 days of the exit of the employee. I am underlining the Gratuity Act provides for punishment by penal action against the employer if the gratuity is not paid within 30 days. The payment of liability can be book provision, pay as you go, or funding through a tax exempt trust. Payment is made to the trust and trust is paid to the employees. Trust is sponsored by employer. As per the Income Tax Act, Part C of the 4th schedule, trust has to be exempted. Set up, trust is appointed by the employer, and trustees will carry out the responsibility. They have a fiduciary responsibility. I think one of my co-panelists will be speaking on this. The responsibility, roles and responsibility of the trustees. They have the onus of taking care the promises made by the employer is met with at any time as per the Act. Now, the tax benefit, if it is on a funded basis, there is a tax benefit for the contributions made to income tax approved trust up to 8.33% of the annual wage bill. At no point in time, I foresee the liability going up that much, except in a year when the gratuity limits were increased from 10 to 20 lakhs. Generally, it might revolve around 2-3% or 4% of the wage bill. I think Rahul will be better equipped. He's more current to tell you this when he speaks. However, when it is unfunded, the actual settlement of gratuity is only can be claimed as a business expense. If company is doing well, profitable, that you have no claim of settlement of gratuity, no tax benefit at all. If there was a funded scheme, the contributions made to the approved trust, there is a tax benefit. In case of unfunded, there is no question of investment, nor the investment regulations don't apply. As we said, there is no compulsion for funding of gratuity liability. Trust can, when it is funded, trust has to invest the fund contributed by the employer as per the income tax rule 67 and 101 when it is with the insurance company. Gratuity can be funded through a product approved by the regulator, which insurance company offers. Of course, funds in both the cases, forming of trust is mandatory. If anyone is introducing a scheme with an insurance company without forming a trust, they are going to create a mess for themselves. Please avoid setting up any gratuity scheme only by taking a master policy with the insurance company. Some of them I have found during my consulting tenure. Trust formation is a must. Only for the funding done to an approved gratuity trust, the contributions made by the employer is a deductible business expense. Self-managed trust or have to follow certain guidelines, and the fund has to be invested as per the guidelines issued by the Ministry of Finance, Government of India, and income tax provisions. Trust can also outsource, as I said, as per the Income Tax Rule 101, to an insurance company by the products offered by insurers and product approved by the regulator more pertinently. And every insurance company has got different type of product features. You can visualize it, you can study that, do your due diligence and adopt that. Companies, SMEs and MSMEs, I would more recommend to have set up this scheme with the insurance company rather than managing a self-managed trust, because you will be hassled with the investment administration and benefit administration yourself, and you can transfer all these to an insurance company. Going further on returns on investment of the contributions made to a trust will help reduce your future funding requirements. It will lower the cost of this liability which is coming. If the returns are low than expected, it could be vice versa. The cost might increase. So unlikely with the present situation products offered, the returns are predictably better, and it helps you reduce your, because returns gets added to the corpus and it reduces your future liability. Liabilities will keep on increasing, no doubt. If someone would say, I would fund and remain, and those funds will start earning, whether it will take care of my liability. No, it is a myth, because as long as your salary and service are dynamic and keeps in, that is Important, the compliance, whether you are funded or not funded. If you are not funded, still you have to file some returns to the government labor, this one, that payment of gratuity paid, and you have to maintain records. And if you're funded, records to be maintained and returns to be filed to the income tax, nil returns, because the earnings of the trust is not attracting income tax, but nil return filing is mandatory. PAN should have the trust should have a PAN number, and this is mandatory now. And you need to file returns year on year. Trust audit, doing an audit of and a balance sheet of the trust is a good prudent practice, and helps you build up a systematic record and better compliance and governance. These returns need to be audited by the same auditor who audits your company accounts. Whereas the advantages to the employer in case of unfunded, yes, the funds may be available for working capital for the business. If the business is earning better than the returns given by fund, still your liabilities keeps growing, and it's not that advantageous to remain unfunded. You may say that it is available to working capital to build my business, but my dear friends, remember your gratuity liability systematically, exponentially keeps increasing, and funding helps you build up a systematic fund ring fenced for the purpose year on year for meeting your gratuity liability. If there should be any bulk payouts, the gratuity fund will take care. If it is with the insurance company, insurance will pay the gratuity through the, of course, through the trust account. And if it is unfunded, if there is a bulk exits, it will definitely greatly impact the business, particularly if the business is trained with not being very profitable. The benefit administration, if it is unfunded, there is no benefit administration except that you will have to honor the claims, may not be expensive. But in case of trust, you do have an administration requirement. Benefit administration and claim administration has to be done. Managing the trust and securities has to be done. Of course, this will be minimal engagement for the employer, but if it is outsourced to an insurance company, you transfer all these, most of this work, except that you are licensed with the additional deletions, paying your contributions, tracking your payments and claims. All this has to be done when it is with the insurer. Now you must be saying, let us, what is the SWOT analysis? Of course, choice of funding is entirely that of the employer and largely dependent on various factors like cash flows, opportunity cost, stability of the business, predictability of the contributions, besides regulatory changes. The opportunity costs company may assess the opportunity cost involved in contributing to a fund versus those cash in the security. A separate fund ring-fenced for the purpose increases the security of the benefit and ensures this payment smooth cash flow. By contributing to a separate fund, the company is not exposed to unexpected, unplanned benefit payout, and any unexpected payouts are met out of the trust or the insurance scheme maintained for the purpose. Company has got certainly attractive tax benefit. It weighs quite positive to save some tax as expenses towards contributions made to the just further deep dive into SWOT analysis versus funding pay as you go. It gives increased security to employees. Employees will know that there is a ring-fenced fund separately to meet my gratuity. Companies, serious companies worth being with because they take care of us and ensuring these payouts which they have promised and they have set up this. And there is a better cash flow management for the company. Reduced volatility of expenses on accounting basis. When it is accounting basis, there could be a volatility. Attractive tax benefits, as I already and funding and investment returns add up for the cost. It's in the cost for is there or notifying of gratuity liability. The weakness is opportunity cost of working capital, which may be available for business, and greater coordination and governance required for trust operations and benefit administration when trust is set up. Many a trust give trust governance a go by. Remember your first principal trust deed and rules with filed for income tax approval has to be followed up for getting a tax approval of the trust. Once approved, the original trust deed rules, the approval copies, everything should be kept in separate lock and key. Unfortunately, many of the companies, whether it is SMEs, large ITS company, have lost track of their trust records and deeds of variation and amendments made over the years. And because the people change, hands change, it is not kept in one place in record key and record there in a very big mess. And consultants like me get an opportunity to clean up this mess, but it is a big challenge. I urge upon whenever you set up a trust, please keep your trust records, insurance policies, amendments being made separately under lock and key, available perpetually when hands change. This has to be there. Threats is investment risk. Investment risk is if it is lower than expected, yes, the funds may not grow, which is rare. When there was a market slump in 2008-9, probably CFO saw the fund balance lesser, closing balance less than the opening balance. I don't think such situations will repeat. Those days we had more of defined traditional policies, though insurance company had come out with mark-to-mark unit-linked plans. But yes, risk of underfunding or overfunding is always there. Company may say, why should I fund this much? This year I'll fund less. There may not be. Or risk of overfunding being very positive is also there. You need to, ideally, 70 to 80% of the liability should remain funded at any point in time. And 100% is not required because there will be exits also. So ideal situation is 70 to 80%. If you say 60% is good enough, but 70 to 80%, the funded level of the liability has to be there at all times. So further, the advantages of funding, I'm maybe at a sort of a repetition. Advanced funding considers exponential growth and nature of the gratuity liability, which is projected over the years and helps build up a fund which meet your liability for payment in some time of tomorrow. With investment returns and employment patterns, it has a basis for impact on that. But still, you still can foresee and plan your cash flows. And though it is dependent on investment return, employment pattern, exits, and other things, if there's a huge exit, there could be exit of huge funds from the trust, all those things. And of course, the market inflation rate, it may impact. The bond yields, when it vary, it will be there. Setting up a separate fund, ring-fenced for the purpose of gratuity, helps better spreading of the cost for the company. Regular contributions is backed by sound investment strategy that enables company to meet the cost of the plan over a long period of time, as and when the liabilities occur for payment of gratuity. A separate fund, as I already said, increases the security feeling of belonging to the employees from the employee's perspective. Contributions to income tax approved fund helps company avail tax benefits, deductible business expenses. Investment returns are completely tax exempt. Advantage of funding with the fund manager. Investments, particularly. Problem of investment administration and day-to-day investment is transferred to the insurer, and headaches of investment, particularly when there is not very huge fund. Even if it is a huge fund, I have seen companies setting up a separate investment team or gratuity to take care when it is self-managed fund. It may not be required for SMEs and MSMEs, and investment risk is transferred to the insurer. Insurers got a dedicated teams to take care of the investment advisory. Trustees must pay the contribution to the insurer on annual basis. Money is invested from the date on which is invested, and it participates in the return. No day-to-day hassles of finding a suitable investment script. When fund is with the trust account, you may not get a suitable investment script which is required. So that being the case, it is better to have insurer managing it. And the insurer also offers both traditional and non-traditional, that is unit-linked plans, which unit-links are marked to market. Unit-linked plans help beat the inflation. Insurer with huge funds has better advantage of investing because he manages multiple trust funds with him, and he can make a better investment decision, will be mostly able to get a better administration is largely done by the insurer. The cost of administration as well as manpower spent by the company will be less, trustees will be less, as the staff for record keeping will be less. Administration is completely transferred to the insurance company. There's a lot of flexibility because one is you have choice of insurance products available by the insurers approved by the regulator, Insurance Regulatory and Development Authority. Insurers offer both traditional and unit-linked plan, which is marked to market. Various options available for redirection of funds under unit-linked plan, portfolios and fund options help beat inflation. There is always a liquidity. Liquid funds are available to pay the claim because insurers will readily have provisions to make the payment. You don't have to redeem security when it is a self-managed fund. There will not be any need to sell the securities as and when from a self-managed fund if required. 100% liquidity to pay out the benefit as and when is there met by the insurer to meet the claims as and when preferred by the employer. Thank you. I don't know whether I was a little fast. If there is any questions, I'm open to answer that. If not now, at a later time when the time is allotted for that. It is little technical, but imperative that you do your advance funding with yourself or with an insurance company. Yes, sir.
Thank you very much for taking us in the direction that the use of insurer for managing the fund is a better alternative. Now let us listen to Mr. Rahul Chaurasia and Professor Manoj Kumar Pandey. That is, in case any MSME or a company organization is thinking of it, then what is the role of life insurance in setting up of the trust? Because the trust is a word which many people are very scared of, that trust will have to be set up, how it will be done, who will be the lawyer and all that thing. Parameters for selection of life insurer, salient points of the trust deed, is switching over from one life insurer to another insurer possible? Because we have come across organizations who are having the trust being managed by a specific company, but they find that we do not get that much of service or support. So we want to have the portability, like in the case of health insurance, people go in for portability. That is it that portability of the life insurer is possible? I am using the term life insurer because general insurance companies and standalone health insurance companies do not offer this product. So therefore, we are becoming more focused to life insurers. So let us listen to Mr. Rahul Chaurasia and Professor Manoj Pandey. So leaving it to them, that is how they bifurcate and how they support each other. So it is open to both of them at the same time. Thank you.
Being a practicing manager dealing with this particular challenge day in and day out, I have requested Rahul to take the lead. I will be sitting in the back. So Rahul, please proceed because you are the right person to guide the entire participants.
So, thank you very much, Manoj sir. Thank you very much, Sethi sir, for such a wonderful webinar. Nanil sir, I must tell that you have made my life easier by telling what I have been trying to tell for a very long period of time, that being with an insurance company makes a lot of sense. But when I tell this, it comes with some personal selfish motive of mine that I manage this fund. So that's why I'm telling you. But this coming from a senior executive like you, who is an independent consultant, has worked with companies like Mercer, it really means that it is very, very important. Unfortunately, rightly told by you, that Section 4A has not yet been notified. So most of the corporates still are thinking or discussing with people like us, and it is like in insurance, there is a word insurance is subject matter of solicitation. Even gratuity fund management has, to a very large extent, has become a subject matter of solicitation. But without taking much of the time getting on the subject, getting on the topic, I would want to project some slides that we have created. Please let me know the slide is visible to all of you. Is the slide on, sir?
Yes.
Yeah. Before I get onto the trust creation and why trust is important, the most important aspect which I've tried to summarize what Anil sir was telling, that there are three independent ways of managing gratuity liability. Gratuity is a statutory liability. All of us agree it's under a Payment of Gratuity Act. We have had a discussion on revised wage code for a very long period of time. That is again like section 4A, revised wage code is yet to be notified. So hence any changes that industry is expecting or industry will have only when it gets notified. But I will not cover that aspect. But right now, as we speak, and Manoj sir, please keep adding wherever you want to add, and I'll also keep asking your inputs. But right now, essentially, most of the companies who are not funded will be in the practice of pay as you go. So anybody who finishes 5 years has to be compulsorily paid a gratuity, whether you have a trust or you don't have a trust, whether you have created a separate fund or you're not created a separate fund. And hence, the disadvantages or the reason of why we should not have a pay as you go, because it shows your a liability in your balance sheet and your P&L shows an inflated figure. Very rightly told by Anil sir that we have a lot of tax advantages of funding. Section 40A9 of Income Tax Act very clearly talks about advance funding of gratuity liability, which means that by funding advance, you get a lot of income tax benefit under different sections mentioned between Rule 101 to 104 and also Section 37 of Income Tax Act. And advance funding is treated as a business expense, which is not in case of any pay as you go liability. Only the amount that you actually pay is treated as an expense in your books, and hence you get only a tax liability on that. The disadvantage that also a pay as you go can have, that if you in your rainy day, when we have had a lot of examples in the insurance industry, wherein we have seen that unfortunately the company was not in the best of the shape and the employee did not get their gratuity payments on time. I would not want to name many, but a lot of airline companies, a lot of other companies, some PSUs also in the past, some of the private corporates also in the past have had to face such tough time, and employee who essentially gratuity is their long-term earning, the retirement earning got impacted. So now why do you need to create a separate trust? Why the word trust comes into a lot of discussion, and what is the essential reason of a trust? All of us have read in our financial management lectures and reading finance that there is a concept of separate entity. Corporates or company are a separate entity than individual. Now within this separate entity called corporate, the objective of creating a trust is creating a separate entity as a fund trust where the money is independent of the corporate. The money will be used, the sole purpose of this money will only be for gratuity payout and not for anything else. That is the very reason why you get an income tax. So the concept of approved trust that was discussed by Anil sir only is that if you need an income tax, you have to put it aside and money cannot be used. Because in your book, in your books of account, you actually treat this as an expense. You have already spent out. Now the trust will pay the money as and when the liability arises. However, it is also very important to note that by giving some money to the trust, you are not completely avoiding the total liability. Trust liability is equal to the money that the trust has. Trust cannot pay anything by its own. Hence, the company's liability every year, and that's what Anil sir was also talking about. And mathematically speaking, about 4.8% as per the latest Payment of Gratuity Act is the liability that comes year on year for every organization, and by discounting, by attrition put into, so you very rightly told by him that 2 to 3% of annual wage goes towards the annual contribution, what we call, unless there is some difference, like if a revised wage would have come and if the 5-year gets reduced, or if your 20 lakh liability goes up, then you may have some more past liability coming up. But normally, between 3 to 3.5% of your wage bill, which is essentially basic in most of the corporates, and basic plus B in case of PSU entity is paid towards the gratuity. So the two other options that you can have when you create a trust is managing fund by themselves or outsourcing to an insurance company. There are a lot of discussion and advantages and disadvantages of managing fund by yourself. If you, but the reason, if you want to manage fund, you have to understand that you are taking the entire credit default risk to management of fund responsibility to everything on yourself. and whether is this your core job or not. This is a very simple thing. Nowadays, I just deviate from this a bit. Nowadays, the concept of wedding planners have come up because they can do things more professionally. And this is completely different from this topic, but the way they do the things and take care of liability for a very small cost, they make your wedding memory very pleasant. Similarly, in a gratuity concept, give it to the expert, give it to those who are actually handling it, rather than managing all by yourself. You have ILFS, DHFL kind of credit default risk. You have different other risks. You have a lot of compliances to follow. You have to maintain a patent by 57.2. You need to be in different instrument at a certain percentage. But that becomes troublesome if the fund is very, very small. If it's a very large fund, maybe a 30, 40,000 crores of fund like some of the banks have, it may still make some sense. But for a smaller, for a fund up to 100, 200, 300, 500 crores of size, I don't think it will make a lot of sense. Processing to insurance company is convenient, and it also has an additional component of insurance. So what is the benefit, the advantage that you get with an insurance company is not only the fund management, but also for the future liability. And I put it by an example. For example, if I'm working with in life and my 18th year already, and I have 18 more years to serve, in case something happens to me today, my family will be getting 36 years of my gratuity on today's salary, 18 years from the fund, 18 years from the insurance that my current life insurer would give. So that is also an advantage that in detail, I'm sure some of the other panels will talk about. Now getting onto the trust, why a trust is created and what is the process of creating a trust. Trust, as very rightly told by Anil sir, and I'm adding on to what he started, that only the sponsor of the trust is the employer. The employer sponsors the trust, and hence, when they are sponsoring, the ultimate body of the organization, which is board, the board approval or a board resolution is a necessity for a trust creation. Now, because you are wanting to have a tax exemption, you're also required to have a application to the Commission on Income Tax in the same ward that you are filing your income tax. Because all the money that you give to the income to the gratuity fund trust will actually be giving you will be treated as an expense, and hence an approval of income tax authority is very much required. The industry practice though is that you apply to the CIT, and CIT takes its own time of 1.5 months, and you start funding, and normally this has been the practice. But logically, technically speaking, you need to have this approval, which is very, very important. And for that, the trust rules and be circulated. Very important thing is that which some of the MNCs may want to know, that is this payable outside of India or only of India, but because Payment of Gratuity Act is applicable in India only, so all the benefits are guaranteed shall be payable in India, and it should be in INR or INR currency only. And like I told you, the sole purpose of this fund shall be provision of gratuity benefit. You cannot use a gratuity fund money for any other purposes, and hence the money that you have taken out as an expense does not belong to the corporate. This will only show as an asset, whether you get in the AS 15 valuation or in the AS 19 valuation, it will show as an asset in an annual report and nothing else in your balance sheet. It will keep earning, and the earning also is taxing. It has already been explained by Anil sir in the previous system. So moving on to what are the formalities, sir. Manoj sir, if you want to add something on this aspect, please do that.
Please go ahead. You are a better person. I am just adding in the chat box itself for the clarity, wherever I'm feeling like.
Okay, so there are some certain checklists. You are creating a trust, which is an independence. You need a non-reduced stamp paper of 300, and some places 500. So please check with the local authorities. Earlier it was 100 rupees only. From that value of stamp paper, please check. You need to have a track of board resolution. I will show the format also, that how do you go to a board and how does the board approve. Trust deed and trust resolution, and that is where the role of consultant like Anil sir or insurer like us comes into place, wherein we will have predefined format of trust deed and trust resolution. But one of the most important thing in a trust deed is your trust rules. It was very discussed by two of the panelists in the previous discussion that your rules can be favorable to your employer. Now, Payment of Gratuity Act is essentially a background basis which you have to create gratuity. But can you make it better? Can you make 15 days to 20 days, 25 days, 30 days? Yes, you can do that. Can you make 20 lakh rupees to unlimited? Yes, you can do that, subject to tax liability. And can you make 5 year, lower than 5 year, 1 year, 2 year, 3 years? There are multiple examples. If you want to change any of these rules, this is very, very important that you mention that in your trust. Also, basics like PAN is the most mandatory thing now for every financial transaction. The trust bank account and trust PAN is very, very important, which is required. You need to have trustees. Now, who are trustees? What is the meaning of trustees? Trustees are those who are essentially the uh, caretaker of the trust fund, trust money, which are acting on behalf of the organization, on behalf of the organization, and they have their roles and responsibilities. I'm being told that one of the other co-panelists will be talking in detail about it, so I will not be taking this up. And last and most important thing, that how much to fund, the actuarial report also plays a very, very important role. That what is the actuarial liability or the actuarial report that you have as a liability. Not just to give it, make it simpler for people, the checklist are who are the people who are going to sign, who are the authorized person from the organization side and from the trust side, where which is the bank, where the trust bank account will be maintained, trust PAN card and bank detail, name and the signature address of the trustees, non-judicial stamp paper in the name of the trust you have to buy, extract of board resolution, company's IT PAN card number because company is also going to get tax advantage, and name of the fund trust. For example, Steel Authority of India Limited Gratuity Fund Trust, and likewise any other organization. Normally people keep the name like this. So far, this is the checklist of creating a trust. I'll just show you the certain format. These are the application has to be filed. There has to be a code stamp fee, board resolution. So right now it is too verbose a thing for me to show. But to give you a very simple, there are multiple trust deed format available. If need be, I can also share trust deed, and it's almost with all consultants like Mr. Anil Logo or people like us who are managing on behalf of insurance company. We can give you the format of trust deed. It is very, very important to identify the name, identify the individuals, identify the rules. Rest everything is more or less there unless you really want to make a significant change. One important thing which is important, I have seen that in all old trust deeds, the name of, because earlier before 2001, the other insurance company did not exist. It was made solely in the name of the government insurance, LIC, Life Insurance Corporation of India. And hence the word corporation is used in most of the trust deeds. In that cases, which I'll be talking in detail in the future slide also, in that cases, you may need to file a deed of variation. But if you are creating a new trust, it is recommended that you use the word insurer as defined in section 28 BB of Insurance Act. So that it gives you tomorrow, if you want to switch between the insurer also, it allows you, and you don't need to go to CIT once again for an approval. Because any material change that you do in the trust deed, you will have to go to your Commissioner of Income Tax, you will have to seek their approval all again, which is another process. Hence, it is recommended that when you are creating a trust deed, you please put all these details, the final details you must read, and please don't create, nowadays you should not be creating a trust deed, stopping yourself in any investment avenue, be it self-managed, even we were talking about investment of fund money. Normally, clause 9 of the trust deed talks about investment of fund money. So you should be very carefully copying the provisions of Rule 104, if I'm right there. Rule 104 talks about how the money has to be invested. It can be whether a scheduled commercial bank or a life insurance company, or as per other provisions 672. So mention that in complete in totality, and then the trustees will be deciding where to invest and how to invest and how much to invest. That's very, very important. In an application to Commissioner of Income Tax, he would need the trust deed, trust rules, certified copy of board resolution and application for you to give take an approval. And bank account will also require trust deed. So trust deed is the prerequisite of anything, be it a PAN card application, be it a bank account opening, or be it a CIT application. Also, the insurance company takes the copy because tomorrow they are obliged to pay you as per the trust deed of the organization. The insurance company also seek a copy of trust deed. This is the steps to start a gratuity or a pension fund. This is how a draft board resolution would look like. That and it could be every company. And I'm using the word Bajaj Allianz because I have joined Bajaj Allianz, but it could be any insurance company. Board resolution could look something like this, or the company secretary can define their own languages. That the gratuity benefit is secured to a scheme of an insurance with Bajaj Allianz or any insurance company for that matter. And Mr. ABC, who is the company secretary, is able to authorized to initiate and complete all necessary. This is the draft board resolution that will go along with the trust deed. In fact, to trustee resolution when they are investing. So after the trust deed is created, trustee resolution also plays a very, very important role. That where we are investing, and every investment that we take as an insurance company or it goes to anywhere, the trustee must mention that and resolve that in their trust deed. This is also very, very important. This is a format of trustee resolution. I'll again tell that the language may change, but the ethos has to be the same. This is right now about the trust formalities. I did not go deliberately on the trust rules, but anything, Manoj sir, you would want to add on the trust rules, trust formalities, or any question that is there? I've not been seeing the chat, but if there's any question on the trust rules, I'll be more than glad to answer. Like Anil sir has very rightly told that the value of the stamp duty will vary from state to state, and I echo the same thing that it is have to check with your own state how much 300 rupees is normally what I mentioned about Delhi, because I'm there Delhi, but it could be different in different part of the places. And some of the points have already been mentioned in that chat box by Manoj sir. Manoj sir, over to you before I take on to the next topic.
Rather, I will ask a question to you because you have been active in this particular space. Whatever the data we have, we believe that only 12 to 13% of our workforce is working in organized sector. And whatever PF, gratuity, leave encashment we talk, that relates only to those 12, 13%. Bulk of the people are working in not so organized, rather small and medium-sized enterprises. And there, these particular concepts are not there. So the moment we are, I mean, because you are in the business, have you seen the traction that now even the not so well and not so big company have started going for the trust formation and taking the help of insurance company for management of their gratuity? Because I believe, because I am not in industry, I believe that situation may not be that great in reality.
So you are very right on that aspect, sir. I would answer this question in two parts. First of all, Government of India through its revised wage code tried to answer this problem of unorganized worker by implementing the concept of gig worker, and wherein the gig worker were also made eligible for gratuity and pension, gratuity liability system. So gig worker is something which is part-time worker. That's a name given the part-time workers. And even if you're working for a limited period, some of them work as a consultant for 11-month period, 1 year period, 3 year period. Even for the limited period, gratuity was to be made essential because it has not been notified. It's still not an act of law in the country, but that will to a very large extent solve that aspect. Having said that, a very pertinent point which was raised by some of the companies deliberately tries to avoid payment of gratuity by shifting their employees before they finish 5 years. That aspect, which is more to do on a company's ethos, is something which is yet to be answered until the time Government of India actually makes Section 4A essentially or notify it. I don't think gratuity as a concept can run that fast. Having said that, nowadays we have also seen a very positive change. While most of the companies utilize as a third-party worker or third-party employees in their for their day-to-day task for work, maybe for office boy or maybe guard. But some of these companies which provide this manpower companies have also come out to in large numbers to companies like us to set up their own gratuity. I mean, I would like to take an example of G4S. Group 4 Security, one of the largest security company in the country today, has a very beautifully established gratuity trust, and they pay gratuity to all their employees, despite maybe working with a different organization, and they are gig workers essentially in that organization. So this concept is slowly taking a change. Companies are involving. Gratuity essentially and primarily has been used as a tax vehicle or a tax something to save taxes, and hence companies which were into some zones, SEs, special economic zones, where they were getting tax which are not related it, or some of them comes out with that right now my funding I will not want to do because the cost of borrowing is much higher, and all that also is a reason. Having said that, I would still repeat what Mr. Noble has told, that funding is very important, essential for the overall health of the organization, because you are also making this safe for the employee, which he leaves in 20-30 years of working in your organization. He would be getting that element. So creation of trust, getting income tax benefit, and more than that, payment of gratuity and taking a fund for that is a very important concept that I believe every company must adopt, be it small or large in nature. The payment of gratuity, I very clearly say that anybody who has more than 10 employees should be paying gratuity. Now, is that taken completely? There are so many shops in Delhi which will have more than 10 employees. Are they paying gratuity? We go and really check it. So as a concept on ground, we still have a lot of things to look at. Corporates, yes, they are very seriously looking at it.
I think the main target audience over here is SME people. neither the big corporate houses nor those shops employing maybe 10, 11 people. My second question, just for the more clarification to you, is maybe one of the hindrance of going for this gratuity management is this concept of trust. सुनने में ऐसा लगता है ना ट्रस्ट बनाना बहुत ही मुश्किल वाला काम होगा और यानी कौन इस लफड़े में पड़ेगा. Can you assure the audience that this particular process is just a formality? Formality तो खैर नहीं होता होगा. It must be more than that. But it's not a cumbersome process which people should avoid. At least those employing 50, 100, 200 people. Because I doubt even these kind of employers are not getting into the proper arrangement of their gratuity fund. And initially, Jains have told that people have been asked to resign technically just to avoid the payment of gratuity act. So, ये trust बनाना कितना मुश्किल है या कितना आसान है? Kindly explain this.
While more than me, I think Anil Lobo sir will be the right person to answer. But let me answer a few points, and then I would also invite Anil sir to take this question along with me. First of all, creation of trust is just a state of mind के बहुत difficult. It is the most easiest thing. In life, we see with two perspectives. हर चीज बहुत difficult है, हर चीज बहुत आसान है. For that matter, even doing engineering is very difficult. Marriage is very difficult. Running a corporate life is very difficult. So ऐसा कुछ है नहीं. On a serious note, if I talk about if I talk about creation of trust, first of all, this is not a trust as per Indian Trust Act. This is a special different entity that you are creating just for the purpose of tax. You have companies, insurance companies, you have consultants like Mercer, WW, people like Anil Lobo sir, who have predefined trust deed बना हुआ है. उसमें आपको सिर्फ fit करना है. It is like, and now creation of trust is as easy as like opening a bank account. आप जाओ अपना डॉक्यूमेंट लेकर के जाओ, 2 से 3 घंटे 4 घंटे में इंश्योरेंस कंपनी का एग्जीक्यूटिव और somebody from a consultant like Anil sir will help you and create this. This is a one time, and this is a one-time process in life. You don't need to create trust every year. Please understand that. The compliances that Anil sir talked about is also something which is not mandatory in nature. कि आपको balance sheet बनाना है. It is recommended. It is recommended, and when you have a trust, you must do it. So, Anil sir, would you like to add some points on the question?
To answer Manoj and Rahul, you answered it, but still.
Sorry for interruption. My suggestion is that let us move to the next expert. And then when we are coming to the question answers, at that time, we will have involvement of all of you in moving further so that we can maintain.
My next topic is pending. I will now move to the next topic, which is and which I'll very softly take the fund management, and we'll go to the next topic wherein outsourcing the insurance company and all. So first of all, there are two ways that money is invested. One is a traditional is nothing but you get returns at the end of each year, and you get nothing but a NAV-based concept wherein you get money and you have a mark to market. Both has their own advantages and disadvantages, but just for the purpose of explanation to all the audiences, that in a unit you get a mark to market kind of return, wherein in a long term equity and debt combination can give you higher return. A traditional gives you a consistent return year on year. But coming on to the topic that was asked, that is, how do you shortlist life insurance company? Is a very, very important point. And there are the three most important things that one should look at while shortlisting a life insurance company. One is the safety and security of fund. Stable and superior fund management and returns can self-managed funds. So self-employed funds say better and sound financials of a fund manager or insurance company. And there are various parameters well defined or adopted by the industry while they're choosing. One of that, some of these are my recommendations, but one may take their own decision. Profitability of an insurance company plays an important role wherein say that the company is in good shape. So if you are giving a very large fund, how profitable, how much of the reported profit and losses is a very, very important concept that one will look at. The other important thing to look at to measure financial progress is the net worth of an insurance company, and how big is the net worth, how they have grown. Solvency is a predefined parameter by the regulator themselves, and in solvency they say that for every solvency by definition is for every 1 rupee of liability and an asset margin of 1 rupee 50 paise. I'm not getting a very deep detail about it, but that also indicates the financial health. There are a lot of discussions and debates around it, that how will it impact the gratuity payout and all that. Having said that, this is certainly a health indicator of an insurance company. And last but very important is the total AUM and group AUM. So what is the money that you're managing? What is the money that is there with us an insurance company will help. And then when you're deciding an insurance company, once you have found that these are technically qualified, you need to look at their fund performance. And more important in the fund performance, the vintage and the credibility. What also happens is that I may, in the lust of giving more returns, may take a lot of risk going to IID allows us to double it kind of security. Which security we are choosing, and that may have a default probability, is something that the companies must decide. And hence, company with a higher, more secure fund, despite a unit linked or a non-unit linked product, is something which is recommended. And hence, credit rating should be 1 point. And more than that, client list and service appreciation letter is important. Now, the last point that I would want to just to summarize this, these are the points that I talked about: safety, fund management capability, safety, trustworthiness, fast performance. All these are there. Last and very important, the steps to transfer fund from an insurer to insurer. Now, you need to, the only thing that you need to look at is your trust deed. Does it have all the insurer defined or not? If it is not, go to the insurance company, go to a consultant, ask to file for deed of variation. You need to look into your trust deed. What is the definition of insurer? If it is limited to an insurance company's name, you'll have to open it to go to another insurance company. The company can invest into multiple insurance companies also. So there are multiple examples in the industry wherein companies are investing with us as well as many other insurance companies. But it depends upon the fund size. If your fund size is very, very small, there is no point investing into a lot of companies. But if your fund size is as high as like 10,000 crores, it is recommended that you go with 2, 3, 4 players from a safety point of company. And then when you are going to an insurance company, the formalities of that insurance company needs to be done. These are the very basic steps. The transfer is very, very easy. The only thing that you need to check is trust deed and nothing else. And to give you an example on the health of insurance company, this is a slide that talks about different insurance companies, the top insurance company, how they've been faring. This is a pure IRDA data, so I'm sharing it for the purpose of everybody. And you can decide by discussing with the executive of this company whether this suits you or not. This is all from my side. From a, if I could tell you that on the topics, I would invite Mr. Manoj Pandey to add his views on the topics given to us, and otherwise stop hearing.
Nothing from my side as such, Rahul. You have covered all the points raised by Sethi sir very brilliantly, and we will complete. I mean, we will supplement in the question and answer session.
Perfect, sir. So I am going to stop my projection of slides. If somebody who is taking over from me can just take it up.
Thank you, Rahul and Pandeyji. Now it is that we are moving to Mr. B.R. Saideva, who is a very well-known company secretary, consultant company secretary in the North India. He is a lawyer. He specializes in company law matters. He is an expert who has been responsible for setting up of many trusts in the recent years and is an authority on this subject. And the questions which I am posing to him are, that is, role and responsibility of trustees of Gratuity Trust, and how to select trustees from your trust. That is, an organization is having persons from finance, manufacturing, sales, and all that thing. Is it that they should have certain qualifications, certain experience, and credibility with the employees that they should be selected as trustees? So Mr. B.R. Saideva, and that is a well-known person who has also been on the as the office bearer of Institution of Company Secretary and well-known figure. Yes, sir. Saideva, sir.
Thank you, Sethi sir. And good morning, friends.
Sir, one point I will like to add that role and responsibility, you will also bring in some aspect of Ministry of Corporate Affairs, that in case an independent director is made a trustee, is it that any violation can result into prosecution of these directors or trustees, and its correlation with the D&OE policy, which is given to the clients by general insurance companies? Thank you, sir.
Thanks, Sethi sir.
Yes, sir.
Before coming to this question and then to answer it, because there was one point in between that the people have very less trust on the trust formation. Actually, this trust is formed if we see because I am from legal side, so I will talk something more about the law point of view. Actually, every trust in India
सर आप पूरा दिख नहीं रहे हम लोग को, थोड़ा सा आप अपना एंगल बदल लीजिए.
is it?
थोड़ा सा मे बी लाइट का रिफ्लेक्शन ऐसा है कि वी आर नॉट इन पोजिशन टू सी यू.
Oh, very good suggestion, Pandey.
Better, but still more
Is it
improvement.
better now?
You are much attractive personality. So let us have the full view of yourself, sir.
अभी भी थोड़ा सा एंगल बदलिए आप, कहीं से लाइट का रिफ्लेक्शन आ रहा है.
पीछे कुछ रेड रेड नजर आ रहा है जो कि आपकी फोटो को अफेक्ट कर रहा है.
थोड़ा
जरा सा
आइए, आप एंगल बदल लीजिए.
बदलिए, you will look.
Okay, yeah, something is coming in between. But all lights are.
So just keep left side, just come left side. Yeah, more left, more left, more left. Yeah, that's what, sir. That's what, sir.
Better. Much
Great.
better.
Actually, in India, there is only one act which regulates the trust. That is Indian Trust Act 1882. Actually, this was formed way back in the British government time. And this regulate only the all trusts which are formed in India. And there are some states, like in Maharashtra, they have made their own public trust act. So whatever trusts are formed in Maharashtra, probably they want that I think it is called their charity commissioner. So all trusts are required to be registered with the charity commissioner also. So when we talk about trust, there are basically three parties which have to be involved in a trust. One is the writer of trust, second part is the trustees, and third part is the beneficiary. So first part, when we come on the question of company side, when we talk about the PF trust, company is the writer of trust. Because this is the company's property. So the properties, and I think my sound is clear or it's fine?
Yes, sir. Sound is clear, sir.
Okay, that's great. So company is the writer of the trust because the property is held by the company. So they are transferring that company's assets in the hands of trustees. And trustees are supposed to utilize the benefit of that fund or the property for the benefit of beneficiaries. So who are the beneficiaries? They are basically the all employees for which the gratuity or the whatever the assets are there, they are managing it. So now the question of Setiji was that who can become the trustees? When we go into that rules, they mention that in case of gratuity trust, there has to be the equal participation of employer and employee. So when we see, of course, from employer side, there has to be either the managing director or maybe some executive director or any person who is the managing or where we can call that he is the employer for the purpose of that company. And like usually I find there are 7 or 8 trustees in a trust. And I got the opportunity of forming more than a dozen of trusts during my practice of last 25 years. Then I found that usually the people are keeping 7 to 8 trustees, out of which mostly are employees. Either they are CFOs or CEO or HR heads, or maybe the legal heads, because they understand how to manage and how to comply with the legal liabilities also. So as far as independent director is concerned, independent director represents the employer side. So if he becomes a trustee on that trust, so definitely he will constitute that half of the employer side will be from board of directors. He may or may not be an independent director, and remaining we can take from the employee side. And as far as the responsibility point which you asked for, trustees have basically the main responsibility to manage the trust as per the directions set up in the trust deed and the rules framed thereunder. So in the process, we find that what is the direction of the employer or the person who has set up this trust, he has authored the trust, is that to meet out his gratuity liability whenever due. So this is the first liability of the trustees to ensure that whoever employee of that employer company retires, or in case of death or any time when he becomes eligible to get gratuity, the trustees are responsible to ensure that the person or the employee gets the gratuity amount due amount and within the due time also. They should not default on that. Second responsibility or liability, I can say, to manage the trust in a best way. Manage in the sense, of course, nowadays all trusts are managed by the insurance companies because the most of the money, all the trust they deposited, because one of the co-panelists rightly told that it is better to give the money for management to the insurance companies instead managing its own trusts. Because in PF trust, we have seen there was a lot of problems and ultimately a lot of trusts have shifted back to the department itself. They are not managing their own trusts. So managing trust become difficult. But in gratuity trust, because whole of the money, whole of the liability is entrusted to the insurance company itself. So the responsibility of the trustees gets settled if that money is invested there, because they have to manage that money. And whenever the gratuity becomes due, they have to lodge the claim and pay to the beneficiary itself. Second responsibility or liability comes that they should meet periodically. Periodically in the sense, there is nothing that they should meet every month or every quarter or every 6 months. Whenever they feel there is a need or there is even no need, some periodically they should meet and ensure that all compliance are being done. And we usually suggest that whenever there is a board meeting, because most of the board employer side is already there in the board, so they can have this trust meeting also to ensure that all compliance under the Gratuity Act as well as the trust deed are being duly complied with, and it can be taken on record also. Next responsibility on the trustees comes that they have to maintain the proper accounting system. Accounting in the sense there will be income on the investment. So the income is properly recorded. Then of course the expenses are not allowed in the trust account. All expenses are met by the company directly. So there are hardly any expense, but there will be some bank charge or maybe some notional expenses. So a income and expenditure account is to be prepared, and it required to be audited also by chartered accountant, because the amount is also very material. If we go into the figures, it goes sometime in big lakhs and sometime in big crores. And finally, as responsibility, because the trust is a separate entity, the trust is given with a separate PAN card. It has separate income tax number. So they have to file due income tax return also in ITR 5 on or before the due date itself. So these are the basic responsibility and liabilities of the trustees. Shetty Sahab, I think this question is complete.
On this last point,
Yeah.
I have a question. Is it that, and same thing is also posed to Rahul also,
Yeah.
that when the investment is done on behalf of the trust by the insurance company, then the shares or the treasury bonds or whatever it is in the name of the trust?
Actually,
Because the revenue statement and the balance sheet or the monthly balance sheet can be prepared. Rahul?
Yeah, so when we are issuing a policy which is in the name of the trust, so the owner of the policy wherein we are making investment is the trust, and we are accountable to the trust in principle. So if you ask, is the organization the owner, like I told in my statement also that it is very different, the concept of different entity is there. And I think Anil sir is also wanting to add a point, but it is very clearly defined that the asset of this belongs to the trust. Trust is though sponsored by the organization, so it essentially belongs to the organization. But technically, the owner is trust. Yes, Anil sir.
very right.
You need to unmute yourself, sir.
No, sir, I did not get the clarity. Is it that every month one will be knowing that where the money has been invested, what is the return, whether something has been sold, because insurer is managing that trust, that fund. Is it that the trustees will come to know that the investment in such and such share has been liquidated and investment has been made in this share?
No, Shetty sir, no, it is not possible. It is not allowed.
I would like to answer this.
Yes.
That portfolio or a misleading. Day-to-day transaction may not be known to the organization as our own stock. Having said that, most of the insurance companies are okay to share the portfolio of the overall investment. We don't make portfolios for the company exclusively.
Okay, fine. This is
Portfolio
clear.
is overall corpus. That portfolio can be shared at where the portfolio is on a given day. Returns is function of where you invest. So in a traditional fund, returns are announced at the end of each financial year. In a marketing fund, you can get to know your value daily. Every day, end of the day, you can get to know your value.
Now it is at that time we were having Mr. Hitesh Sani was not available, and most of the experts have completed their presentation. Mr. Hitesh, we would like to hear from you because you are also that is connected with InsurTech, and you are also a consultant. That what is generally the corporate strategy of large units, medium-sized units, and MSMEs towards Gratuity Act, Gratuity Trust, or funds for payment of gratuity? And then it is that, of course, we will have you in the panel discussion and where we are answering the questions which we have received from the audience. Yes, Hitesh.
So thank you, Sethi sir, for inviting me here. Been working with a lot of startups in the startup ecosystem through in the past 2-3 years, and especially working in the claim side. We have seen certain cases where people are not aware about how the gratuity insurance works and how even the gratuity is payable. So, right, we have seen a lot of startups are firing people, and a lot of people have been asked to leave. So somewhere this gratuity insurance part is missing in the entire thing, and that is the reason I wanted to speak about it. So usually why this gratuity insurance part and gratuity is missing, a lack of awareness is there on both sides, the employees and the employers, because people don't know what is the benefit of conducting this. While taking some of the cases which we helped in the past 2-3 years. So all of us know the Air India event happened in 2012, where a lot of pilots were asked to leave and their gratuities were not paid. So if an insurance company was there to back that fund, those pilots might have got their gratuity amount. So like this, we have certain cases of ITC and few insurance claims from the Ashoka and Samrat hotels as well, where the PSUs were also involved in getting the gratuity insurance claims. So having said that, the need, yes, we have to togetherly as a community, we have to make away, we have to create an awareness campaign for the startups, and a lot of MSMEs and SME companies to take this up as a to increase the loyalty of their employees first, and to support their employees in their tough times, because if a person is working for 5 or more than 5 years, where generally the gratuity matures, we have to work on those points.
Hitesh, we know that you are an author and you have written a very good book on the various aspects of insurance. Babita madam is also present. She is from PhD Chamber of Commerce, and I am co-chairman of BFSI committee. We make a request or a suggestion to you. Why not you, along with support of Rahul Pandey and Mr. Lobo, and write a book on this one, which can be in English, which can be in Hindi, and this can be published under the banner of PID Chamber of Commerce, and which can be for benefits to our members located all over the country, and good number of them are definitely MSMEs. And we are having very active committee working on startups. That is a wonderful role has been played by Mr. Saket Dalmia, President of our Chamber of Commerce during 2023 in promoting startups in the country. And this can be of benefit to all. And my straightway suggestion will be that it can be in English and another can be in Hindi version. Let us take this message to the lakhs and lakhs of people, the employees, and maybe CFOs, maybe the directors, owners, and founders. So, we will be pleased to have your concurrence in the coming days in writing, so that the team can start working. And we will definitely be honored to have this book.
Sure, sir. We can work on this.
We can work on this. Okay, now the time is that most of the experts have given their comments, and here are some of the questions which we have received from the audience, and they are not in any sequence because they are just as they have been received. First question is that our income tax approval is pending from the tax authorities. Is it the right time that we park money under the gratuity scheme with the insurance? Will it be accepted by the tax authorities in suitable manner, or they will say that no, you were not having the approval, so money deposited prior to that is not eligible to be taken under required accounts? Yes, please.
It is under this case, generally what happens, how the trust operates.
Yes.
Basically, as and when the employees to get the gratuity, he will apply to the trust. Trust will send the application to the insurer. Insurer will pay the amount to the trust. Trust has no source of income. Only he will get the check, the amount received from the insurance company, and then he will issue the check to the employee. This is the only process of the trust. Why he has an income? Sometimes why he's having the income? Because he has paid the check to the employee on account of gratuity, and he's not encashing that check. As a result, they are having the fund in the account and they are getting the interest on that. They have the source of income. Most of the cases I have seen, all my employee, now the process has changed. Now the bank transfer is there. Earlier the check used to be issued, and check takes time to deposit and cashment, and so they are having the fund, they get the interest. So small income was there in the trust. Otherwise, they don't have any income. No other amount is rotated through the trust account.
I reword the question to make it clear.
Mr. Sethi, I got your point. You are talking about the income tax approval of the gratuity trust.
Because in the state of Maharashtra, it becomes an assuming that the company is in one of the town and is having concerned district, and every district income tax officer is not eligible to give this one because it has to be approved by Commissioner Income Tax, and there is a delay of 4 months and 6 months in getting that approval. So I reword the question: should the client pay check to the insurance company or should not pay it?
Shall I take this question, Sethi?
Yes.
I would not link to this to the insurance company. Yes, getting trust approvals is part of the Part C of the 4th schedule of the Income Tax Act. There are certain conditions for the trust approvals. Whether it is self-managed or insurer administered, trust has to be approved. Different part of the country, we have had responsiveness from the income tax department, either sluggish or some centers it is quicker. Just because these trusts are not income generating trust for the income tax.
Yes.
Yeah, it is not generated, it's just an activity of approval. Second thing, fortunately or unfortunately, when the trust is being approved, filed for approval, the employer does not follow it up with the income tax at what stage of approval it is. Once the scheme is with insurer, they think it is the responsibility of the insurance company to get you the approval. Wrong. It is your trust, employer-sponsored trust. Please follow it up. Unfortunately, at some lower level people, expect something for this approval of the trust. This is one sad part. It is good to meet directly the income tax officer. I have in my long service succeeded, though as an insurance company, those pre-privatization, we wanted funds to be transferred from a self-managed trust to an LIC managed trust. We got the approval within 24 hours of the income tax commissioner because the conditions are spelled out very clear. There are instances of within 2-3 weeks, but these are very, very ideal situation where we get approval. There is a long delay in trust approvals. I would reiterate that once having filed, please don't forget. Please follow it up with income tax regularly for getting these approvals. It is their last priority. Sorry to say that of the income tax officer or the commissioner get this approved, but for the company it is very, very essential get the trust approved. To keeping the trust records, trust approval copies handy, readily, always available is important. And generally, when the scheme is with insurance companies, you can continue to contribute once having filed and not heard from income tax or any queries of the. I have not seen a trust not being approved so far. Rahul, have you come across a trust being denied approval? I don't think so. There has been a delay. There has been a delay, and few people have forgotten getting the approval, and completely trust papers are lost in the income tax commission. There are sometimes after decades after you see the trust approval is not there. You didn't follow it up or not maintain the record. You have an acknowledgement having filed with the income tax. Maintain it until you get approval. Contribute to the insurance company should not stop, because the moment the trust is executed, it becomes a legal body. The so-and-so company's gratuity trust is set up already. It is only pending approval, and contributions can continue, but follow it up for approval. At no reason point trust will be denied approval. They may ask you to change certain clauses or certain queries and call you for a hearing. You can make an amendment, but follow it up. I used to sometimes joke when I was in an insurance company, when we were helping, though this is a little risky, I think someone needs to carry the stool and sit in the income tax office to get these approved.
Adding on to your point, sir, I have come across certain in other cities, especially like Mr. Sethi was talking about. They are not even aware what this gratuity trust is and why this needs an approval.
Yes.
Ignorance is
Also the fact
the income tax guys would not know, and they would ask us finally that why are you coming for this approval at all, and some unnecessary questions will be asked which they will then not know.
Just to go back to the history, Rahul and Sethi Saab, way back in late 90s, yes, questionnaire checklist was prepared to enable the income tax commissioner to approve the trust. That became the format of the income tax commissioner. Today it is called a scrutiny sheet. It was derived by some officers like us in LIC to submit it for approval when the privatization was not there. This form is I am seeing in each IT circle, they ask different questions, and form has been modified in each circle. It is not standardized. But yes, why your trust is not approved, you need to follow up. Having said that, people, audience here listening may be thinking, setting up the trust is very most difficult. Setting up the trust one time, as Rahul said it, there is a certain processes which, if it is with the insurer, they would assist you. Consultants like me will assist you, help you file with all requirements to income tax. Once having filed, keep the acknowledgement, follow it up. I had a very good HR head here in Bangalore recently for filing amendments. Every fortnight he went. Income tax commissioner got changed, officer got changed, religiously went. He took about 8 to 9 months to get it approved. He picked up the approval copy and he was so happy sharing it there.
So, sir, we deserve compliments in PIT Chamber of Commerce that in the experts, we have Mr. Lobo, we have Mr. Saideva, and Mr. Sani, 3 consultants who are ready to assist the clients and the industry in getting the trust.
Yeah, one tricky situation is
there are many
intermediaries. 1 minute, one word of caution, Sethi Saab. Many intermediaries, in the garb of getting you approval, take huge fee for getting the trust approved. Any queries to answer and all, we are there to consult, but any intermediaries of PF agents or somebody getting trust approved, unnecessarily high fee is paid. That is where the low level staff are expecting some money for getting the trust approved,
Thank
which
you.
can be avoided.
One question which is there is that if an employee has taken sabbatical leave during 5 years, let us say 8 months, is it that he is becoming eligible for 5 years condition, or it is to be deducted from 5 years?
Come again, sir?
Sabbatical leave is being taken by employees for going for studies or for something. Is it 5 years is a holy number that one should have worked for 5 years, one should have drawn the salary, or one should have attended? What is 5 years?
5 years is that it should be more than 4 years and 8 months. The person has completed 4 years and 8 months is eligible for the gratuity. The moment the person has taken the leave and anytime he is without leave, without pay, then he is not eligible.
He is not eligible.
If it is without pay.
Break in service.
If a person has gone for sabbatical leave without pay, then he's not to be counted in that one.
Yeah.
But I have a difference of opinion here, sir. In fact, I have come across certain trust rules wherein they very specifically mention that sabbatical once in their lifetime up to a certain period may be allowed and then be eligible for gratuity also. So if the trust rule very explicitly mentions this and approves this in their board, I think because the payment of gratuity act itself says that anything which is better in nature for the employee can be availed. Examiner sir can add to it, but my
It depends case to case basis.
Yeah.
But if it is included in the deed, then it is payable. Otherwise, as per rule, leave without pay is not payable.
Yeah.
Gratuity Act, as per Gratuity Act, not payable. Company can be considered and say break in service for the sabbatical can be included.
As,
Be included when there is a continuity of service.
If it is a trust, if there is no trust, it is not payable.
Yeah, yeah.
Question is it that some more amendments in Gratuity Act are being discussed or expected in the coming months or years?
So it is already incorporated in the new wage bill.
So the revised wage code itself is there are a lot of amendments. I spoke in brief about it, which is inclusion of limited period working. So maybe consideration on the minimum year service. So all these are being discussed. The revised wage code till the time it gets notified, it is not allowed. So it has been discussed. Has it changed? No. To my the best of my info, and the others can add.
Can an approved fund be transferred to an unapproved fund merely on the basis of NCLT orders on any merger or demerger? This is pertaining to this MCA and NCLT. So Mr. Sadeva and Mr. Jain, how it can be done?
No, the approved fund. What do you mean by the approved fund? Because the company, nobody's company is investing their own. They are doing through trust. If they are doing through trust, it means they cannot intervene in the trust fund. They have to manage. They don't have any interest in that.
Actually, this is very new area. Insolvency and Bankruptcy Code came in 2016 only.
Yes.
And there are only 2 sections which talk about that what will happen to the wages dues during the corporate insolvency process, CIRP, or during the liquidation process. In CIRP, it says that wages dues are protected for last 24 months unless there is a separate TF superannuation and gratuity trust. So which means if there is a separate trust, it will not fall into CIRP process. It will remain with the trustee itself, whole amount. And if the company goes into liquidation also, this trust will be outside the liquidation assets of the company. Means it will not be counted as assets for setting of the liability. So we can say it is a protected fund. Now, if a new company is taking over that CIRP company, so this fund as it will be transferred in the name of the new company. Now, if they go for the unapproved trust, unapproved means I understand which is not approved by the Income Tax Act. I think
Yes.
so.
Yes.
If it is not approved by the Income Tax Act, what I understand already they are having PAN and all, trustees and all things are already set up. It is only not approved. So it will hardly make any difference, because as far as trust and gratuity fund trust is involved, you see any income tax return. Of course, there is an income from the, interest income from saving bank account, as well as income from investments that comes into the income side every year. Even then there is a zero tax. So if that another trust is unapproved, if that money is transferred from approved to unapproved trust also, it will not make any difference from legal point of view as well as taxation point of view also, because in that case also there will be no tax. It will be asset with the new company and will be held by the trustees itself. So it can be done.
Next question is, what can be the violations of Gratuity Act and its correlation with the D&OE insurance policy?
There's no relation.
No relation.
No relation. Reason is, when there is a panel provision is already exist in the Payment of Gratuity Act, what the D&O will do?
So
because in the panel provisions are there, they can the person can, aggrieved person can go to the court, to the labor court, and labor commissioner can enforce to the company to pay the amount. Otherwise, they can go for the receiver to liquidate the assets of the company to pay the gratuity. So what is the option for the D&O? For the sake of fighting a case, that is different issue. But ultimately, he will get the compensation only through labor court.
Sir, I am taking 10 seconds leave from you to bring my charger so that I do not go off. So please permit me. In the meantime, any comment, please, Babita madam, you can come up with any question which you are having.
Query from my side, to all those panelists, why this notification is taking so much time? Almost 3 years have passed. Any idea?
This notification?
This new labor code?
So they are taking the consent of all the states, because some states had not given, so they don't want to go back. Central government don't want to go back. That is not approved in a specific state. So they are taking the consent of all the states. I think 3 states are left out now.
Okay, that's a good progress then. But is it mandatory to take the consent of all the states?
It is better, otherwise it will be a differentiation. One state is following the rules, as the other state is not following. There will labor law discrimination.
Actually, it is falling under concurrent list of constitution, labor. So whatever the laws are passed by the central government, in case of labor, it requires the consent of the states also. So possibly that is one of the reasons which you have rightly indicated, that states' consent are pending. And second, I think that government will is also required. If they want to implement, they can even implement with leaving those 3 states also. But whenever a new act comes, just see on the background, when IBC came, there was a lot of court cases, insolvency, bankruptcy case. When GST came, again, there was a lot of cases. Same way, if the labor codes come, I'm sure there are going to be a lot of litigation first. So probably the government also must be thinking, let the election pass over, then we will do it. Because it came in 2019, and now almost 4 years. So I can foresee it is not coming till May 24. It can come later on.
So it is very beneficial for the employees. I don't know, election point, maybe it will add some votes also.
No, because government, if the government wants to do something, they can do it.
Agree, sir.
But again,
currently, central government will have always the upper hand.
Yes. So if 3 states are not consenting, it hardly matter to the central government. With remaining states, they can continue. Now you see that compulsory insurance. This was enacted in 1987. If you see the background, so 13 plus 23, now it is almost 36 years. So last 36 years, that section 4A is not implemented. Why it is not implemented? Central has already passed the notification. It is up to the states to notify it. And you will be surprised, only Andhra Pradesh did it in 2010. And after then Telangana was separated. Now by default, it is applicable on Telangana. So if that labor law can cover only 2 states, it can leave 3 states also.
Sir, Sachdev sir,
Yes.
I have to supplement to clause 4A.
Yes.
Clause 4A in the Gratuity Act is a misnomer. It
Yeah.
was initially, while drafting, thought that only LIC was there. Liability will be taken over by the insurer.
Correct.
And when the insurer LIC objected, it was kept pending and asked to respective. Even Andhra Pradesh notification is defective. It
Yes.
says compulsory insurance. Is it a term insurance? It should be compulsory funding of the liability. It is not the compulsory insurance.
Very right.
And even Andhra Pradesh, when they notified, LIC wrote to them asking for clarification. What do you mean it is for funding or many companies have taken only term insurance as a substitute for gratuity insurance. No, it is not. You should be funding the gratuity. You should set up a trust.
The gratuity is only funding.
So the very clause here is drafted erroneously. It is not the insurance.
But at least something is there. But other
Yeah.
states, no one has notified, even in Delhi and Maharashtra. These are the biggest industrial states also.
No, but the ambiguity continues, sir, because that's why the insurance company, for the anticipated service, there is a term cover. But for the liability, there is no term cover. It's the liability of the employer.
Mr. Sachdeva, can you draft a representation on this, which PID Chamber of Commerce can take up with the concerned ministries?
City sir, this was my concluding point for you as well as PhD chamber rather. That after coming, because section 4 is very old. Now it is, if I remember, it is 1987, if I correctly remember. So last 36 years it is pending. And IFI is torch bearer for insurance companies. So they can take this lead, and we can support, of course, that this should be implemented now. For any act, you can't keep it on hold for 36 years. And second, in between, this IBC has come, Insolvency and Bankruptcy Code. It is 2016. That time no one has thought. Now in NCLT, lot of employees are money is held up. But IBC law, 2 sections clearly says that if there is a gratuity trust or superannuation trust or PF trust, then this money is outside of liquidation, outside of CRP. It is a secured money for all employees. Just imagine if a company get closed after 30 years, 40 years, and the employees are not even getting their social security. It is like Air India case we were just talking about on that matter. So I think PhD chamber is representing the industry side, IFI representing the insurance side. So these two clubbed with insolvency sections requirement, it can be persuaded with the government that any company which has a debt over rupees 1 crore, they can change it to 5 crore or 10 crores later on. Because for NCLT appeal, there is a minimum requirement of 1 crore of debt default. So if such company is going to NCLT, then they must have this security for gratuity trusts as an insurance policy. I am sure it will give edge to the insurance companies, to the industry, as well as to the employees, all 3 stakeholders. Also to the government, because the employees will get their dues also. So this representation we can definitely draft together.
So let us draft it, and PID Chamber of Commerce is very active in giving such thought-provoking representations to the government, and has emerged as one of the leading apex chamber of commerce in the country. And we will be pleased to work with you, with Mr. Lobo, and even with the academic world of BIMTech and Bajaj Allianz Life and all that thing. That let's push it so that we can bring it, because while under the leadership of Prime Minister Modi, many laws which had become obsolete have been repealed, many new laws have been brought in. But then it is that this is something which is bringing many laws and those things into one photograph, you can say, where it is that all have to intermingle and all that thing for the benefit of the industry. So we will be pleased to work with you.
Happy to share my thought and get involved in this city, sir.
Sorry?
I would be happy to give my note or the 2 cents of thought on this.
Great.
With that is, we are thankful to you. That is, there was one mention that outside of India are not payable or like that, and it is that Gratuity Act is applicable within India. But a good number of companies are now operating in other countries, and they might have hired employee in, say, USA. And if something happens and a case is filed by him or his family that other employees in India are eligible for Gratuity Act, that is payment and all that thing, I am also eligible. What will be the viewpoint of the insurance company or the trust?
So my viewpoint on this is I raise this point. My viewpoint is very simple. If he is employed in an Indian company, he may be in any part of the world. If he is employed in an Indian company and if his payroll are from an Indian company, he is eligible for gratuity. But
He's eligible. Yes.
If he is in the US subsidiary of that company also, or if it is in a company listed in US, payment of gratuity act is not applicable. Whether the company wants to pay it or not pay it is again independent. But from an applicability point of view, and the best that I understand this act, the others who are expert in the act can comment. But I understand that it has to be paid in INR. It has to be paid in the companies which are listed or which are rather registered in India only. That's what my understanding is.
I will add to it, sir, because there are two aspects. One is that, like we take the example of a large company like Microsoft, they have offices in number of companies. So a person who is working in India payroll on Microsoft India, if he is sent back, he is an Indian employee, but he is sent back to US for 3 years. So in that case, it is very clear that if the salary is paid by Microsoft India, then there is an employee and employer relation, then gratuity will be definitely payable, we have rightly indicated. But in other case, if that salary is paid by Microsoft US, then definitely he will not be the employee of Indian companies. There will be a break. And third situation is sometime that US company bills back that payment. Of course, the salary is paid by a US company in US, but they bill back to the Indian company that it is your employee, we have paid it there. So then ultimately, of course, the payroll is processed in US, paid by US, but ultimately it comes to the salary cost of Indian company. Then also he will be treated as an employee because the salary is borne by the Indian company. And when salary is borne, there is an employee and employer relation. And there is another way out. Sometime that foreign national is also employed in India. A US person, national, comes to India. Even if he works in India for 5 years and salary is paid by Indian company, then also the gratuity becomes payable, irrespective he was earlier employee of the headquarter company.
No, sir, it is also applicable to government employees. Whenever the government employees goes on the deputation to some other department, then he pays to the government the gratuity fund for the pension fund also.
Actually, I will add to it because in government companies, the job is secured up to retirement. There is nothing in between. So when government sends some to the joint venture company, like there is a joint venture, Bharat Heavy Electricals and GE, BHEL, GE gas turbines, just for example. So the BHEL person is sent there as a joint managing director. He continues to keep retention on lien on the employment with Bharat Heavy Electricals, irrespective he is the managing director of another company. So when he comes back or does not come back, full and final is given by the government company only. So government has different set of rules for their internal management or the employees. But when we talk about the corporate, if that BHEL, Bharat Heavy Electrical person worked for 5 years in the joint venture company, then gratuity will accrue with the new joint venture company only.
There was a one point which was covered up, but again the question is coming up is contract employees, are they covered under Gratuity Act?
Any employee who is served more than 5 years, he is covered.
No, it is at if yes, it means that if someone is working with a company and they are
For more than
providing
5 years. More than
this,
5 years.
that person has been on this position for last 5 years.
Yeah.
That
Yeah,
is
5
his,
years. He has to work for the 5 years.
that is his role for 5
That's
years.
why nowadays government of India is hiring the software professionals on yearly basis.
Correct.
They are not paying the gratuity amount. They are hiring on the yearly basis.
Okay.
Also, to take care of this point, the revised wage code also talks about the concept of being notified. So, if the revised wage code gets implemented, the revised wage code very clearly specify that if you're employed for a fixed term or fixed period, the gratuity will be payable.
Yeah, that is there. That is there.
Consultants who are working in companies, because there is a phenomena being noticed in industry that some persons will not like to be employee, but they will like to be consultant. Is it that consultant who has been working for 5 years, 6 years, that is, he becomes eligible for this one?
No, there is no employer relationship. For the consultant professionals, there is no employer relationship.
So he is not
See.
eligible.
But sir, in that case, the consultant has to give a professional services bill along with the GST is applicable on consultant. If it is not given, then there will be a position like only the designation is given as consultant. There may be
That
an
can be the designation then it is an employer-employee relationship.
yes. If there is only a designation of consultant, then there will be employer-employer
In
relation.
so many IT companies, the designation is a consultant.
Yes, so they will be employees. But if that consultant is giving monthly bill along with GST there,
But GST, then it is a profession. Then
it is a
is
profession.
not eligible.
Then not eligible. Agreed. Sir.
So the questions which were received, we have posed and all that thing. So maybe Anaki, each one of you can take half a minute or a minute to come up with any point which you might have heard, noticed, which needs clarification. So we start with Mr. Lobo.
Yeah, I think we have largely covered everything. The question remained whether formation of trust is cumbersome. It is a one-time effort. It is good to do. It's a prudent practice to set up a trust. More than that, continue to keep compliance requirements. When it is keep the record straight. Record keeping is when a trust is there is essential, and perpetual continuity of these trust records and insurance policies.
Mr. Sajdeva?
I would like to add on trust income tax point of question which came in between. To my view, whenever I set up a trust for a company, we filed that application with the Commissioner of Income Tax of that district, and then application goes to the headquarters of and all that. So my experience says that they will issue one because for them it is not a priority area, which was rightly told in between the discussion. So file will remain as it is there. Someone has to visit and meet the officials because it is physical application till now. Because lastly application which I have filed, it is also physical, it is not online or faceless. So one has to visit there. They will issue one deficiency memo, they call it DM, telling that this is like, they submit like this more information, something they will write. It is their process. So when you submit again, you will get the approval. And then leaving one case, which I filed in 2020, prior to that, all I have the approval, except for 2020, it is almost 3 years, maybe the lockdown period in between last 2 years. So for income tax approval, one has to follow it up either directly or through consultant. Otherwise, for them, it is not a priority area.
Sir, we are having the PID Chamber of Commerce is very active in policy advocacy, and one of the special projects which they are having is ease of doing business. And we interact with the ministries on this specific point. If you can draft a representation on this,
Yes.
then if everything has become digital, even this can also become online application process, and it can be approved in maybe 7 days time by some agency which might be sitting in Bangalore, like most of the tax returns get processed there. This is also something which is for the benefit of labor, employees and all that thing, and insurance companies are definitely getting business out of it. So we will appreciate if Saideva sir, you can draft a representation on this, and PID Chamber of Commerce will be pleased to take it up under ease of doing business project of its.
I think it is very good point, because 80G and 12A, which are applicable on trust for income exemption and all that, that are also online now. But
Then
this
it can also be made online. That
Yes,
is,
correct.
this harassment of companies or trustees or accounts department, let us just bring an end to it
Yes,
and work for the growth of Indian insurance industry.
very right.
Question which is Rahul, it comes to you is that the funds which are received by insurance company under this gratuity thing, are these also counted in the premium income of the life insurance company, which is the one reads in media that this company has this much of premium during this year or like that, or it is just a separate entry?
So these are certainly counted as a premium income. There are two types of premium income for any life insurance company: individual premium and group premium. This is part of the group premium, because group essentially means more than one people. So come as a definition of group insurance, and gratuity is also part of group insurance premium. So under group insurance company, group insurance premium for every insurance company just managing this fund, it will be inspected and will be adding on to the people. In fact, group fund AUM and retail fund AUM are also reflected separately in different disclosures of insurance. It is very much there as part of our premium.
It's part of the premium income. It means that if one has to have a separate topic for discussion and all that thing, that this life insurance penetration figure, which is being told and as a percentage of GDP and all that thing, we are being misled by counting this figure in that one. Something has to be done so that
There are products which is certainly adding to the penetration of life insurance, like microfinance product, like NBCC product, NBFC products. They are there. Gratuity is also to a large extent is also an insurance penetration, only in my opinion, because it is adding to the benefit of a lot of corporate employees for their own retirement. So while I don't know the aspect on which you are talking, but having said that, reporting point of view, it is certainly part of group insurance scheme. Anil sir is going to add something.
There is certain amount of element of insurance along with the gratuity. So only thing what pains me is that the gratuity insurance was supposed to be towards the what gratuity would accrue towards till retirement for the anticipated service. Because of the competitive nature of this business, insurance companies tweaked this term insurance, made it a nominal 1,000, 2,000 or 5,000.
Okay.
This happened only after the privatization of the company. Instead, if it was remaining as towards the anticipated service gratuity, when it is with the insurer, there is a accrued gratuity coming out of the fund which is with the insurer, plus the anticipated coverage will be a decent sum of amount, and that would also go as a term cover. And term cover premium is collected by the insurance companies. So it should not be reduced to just a comply with the norms of having 1,000 cover, nominal cover, just meaningless.
So I will add a point here. It is also to do with multi-insurance concept in gratuity fund management. Now, when there are more than one insurance company, it is not prudent of any company to take multiple insurance schemes from multiple insurance companies. And hence, other insurance companies reduced to that 1,000. And still, I see a practice wherein one of the leading insurance companies will have the future service liability insurance as well. The rest will have a minimum insurance company.
But in the bargain, all will have only 1,000. This is what I have seen as a consultant. That is the sad part.
I would agree, sir. That is a practice in some part, but still, the differentiation exists. Many companies.
I agree. It should be there.
It is good. point came up as a point of introspection, and that is that we looking at it, that we are telling the country, and that is so much is the premium of life insurers, that reality it is different.
Yes.
Rahul, your viewpoint, please. Any comments you are having?
No, so I think this has been a very interesting subject of my liking for last 17 years I've been doing that. I would just end with telling that each corporate must look at gratuity as a very, very important and strategy aspect of their liability, and funding must be looked at by all of them. In the okay, we must do business, we might expand business, but some necessary important liabilities. And what happens, unfortunately, also the employees who are there, who are decision makers on behalf of the corporate, for them also it is important, because when they retire, when they leave the organization, they will also get the gratuity. But they themselves are not very much on after this, and they don't want to set this up for whatever reason. They have to reconsider this, they have to look into this, and they must look into setting up gratuity fund schemes with whoever they feel comfortable with, whatever, but they must have a scheme in totality, is what I intend to say, is my viewpoint.
I just want to add one thing which thought came to my mind. Somebody also asked this question, whether gratuity should be taken as part of CTC. This is a contentious issue. I'm quite against HR giving in their reward statement that gratuity is being paid at 4.7% to you. If gratuity is part of the CTC, then after 3 years of exit, one has to pay back that amount collected from my CTC. Gratuity is the employer's liability and should not be as a employer statement saying that this much is contributed towards gratuity from your CTC.
That is a wrong practice, because
I have had debates with HR. Mr. Jain. I have had debates with the HR that this is not a right practice what you're doing.
This is the post-service benefit, not that during service benefit.
Yes.
Sir, no comment on HR departments, but in the recent years, their importance has gone up and they have become over smart in projecting themselves.
This is the wrong practice they are following.
Practice.
It should be over and above the this gratuity is given. It should
This is
not
a retirement benefit. This is a retirement benefit.
Pandey sir.
Thank you very much, sir, for arranging this particular webinar, a very essential one, and because most of the time people are not aware. As a part of a leading business school, and I can contribute always in anything which is going for awareness. Maybe, sir, we can think of having a one-day physical mode training session for the MSME, particularly working in NCR zone, particularly in Noida and Greater Noida. I will be very happy if at all PhD Chamber of Commerce, and I'm sure my director will not be saying no to this proposal. तो सर इतना तो हम लोग कर ही सकते हैं कि, और रिसोर्स पर्सन की तो कमी नहीं है, हम लोग दिल्ली में ही बहुत लोग हैं. So I will look forward for this association, sir, and we are ready. And मैं बस एक ही चीज कहूंगा कि जो आपने मुद्दा उठाया ना, वो फंडिंग वाला प्रीमियम का, आप सही पकड़े हैं सर. That particular aspect is very, very genuine, and if that is excluded, LIC बहुत नीचे आ जाएगी, because right now LIC is claiming to have a market share of 65%. In reality, in retail sector, they have gone around 30 now, and that big 65% so-called is coming only from the fund management. तो बिल्कुल सही है. मैं पर्सनली बहुत ही इसको, ये जो इंश्योरेंस पेनेट्रेशन और डेंसिटी वाली जो पैरामीटर्स हैं, दे आर नॉट गुड. नाउ टाइम टू रिप्लेस इट विथ protection gap, because that is the only insurance part. So thank you very much for invitation, and I really loved meeting so many people, and thank you very much, sir.
Media people are very, very supportive to the articles being written by the academic world. So my request to you will be that write an article on this one, thought-provoking article on this, and let it be published in Economic Times or Business Standard, so that Finance Ministry and the regulator and others can have that, yes, now this point is being noted by the...
I will do it, sir. This was a very good point coming from you. Question, Shredder.
Mr. S.K. Jain, sir.
I think the most of the issues has been discussed. Only the issue is the audience must be thinking it is trust is the fund-based investor. I think generally the fund trust is created only for to pay the premium and handle the payment of the gratuity. But most of the discussion it is seen that trust is investing the fund with the insurer and they are earning the profit. I think that is not the main. For the gratuity, it is only the accumulation of fund by paying the annual premium to the insurance company. It is the accumulation of fund, not the liability of the insurer to pay the total liability of the gratuity. This is the main concern.
Thank you. Mr. Saini?
Thank you, sir, for conducting this session. I have one question from for Rahul. All the whatever the fund it is, whether it is managed under the pension fund of the insurance company or the normal investment fund of the insurance companies.
No. So there are different aspects to it. There are different type of funds that we manage. We manage some unit portfolio also. We manage some traditional portfolio also. So if you're talking about this was the L26 of IIDAI, which comes from the insurance company, the pension and group scheme would include only the traditional aspect of the fund. It does not include the ULIP aspect of the fund. So the ULIP would come separately under the ULIP portfolio. The pension and group scheme would come under only the gratuity traditional scheme would come under pension. And a lot of things are reported separately. So there is a life insurance component to it, and so some of that may also be part of life fund. So the reporting is very, very independent and separate, slightly complex than how it is shown and projected.
Thank you, Rahul.
As we have covered up all the words and all that thing, and now it is that I hand over to Madam Babita Sharma for her comments.
Thank you, sir. Thank you so much for conducting this webinar so beautifully. And indeed, it was very knowledgeable. I must say this knowledgeable discussion we had today. Me, myself being the finance professional and working in the finance field, I also feel that there were many points that we have discussed today were new to me, and it was a very knowledgeable program. So I will say that this was a very wonderful program. And as you rightly said, we will take up all the issues, representations to the government. So formally, I will just convey my vote of thanks. A very good afternoon to eminent dignitaries, esteemed members, participants. A very good afternoon to all of you. And on behalf of PhD Chamber, I take this moment to give my vote of thanks to everyone being here with us in this important webinar. And I would like to convey my sincere thanks to all the dignitaries, esteemed speakers here with distinct expertise for sharing their valuable information and insight in this important session. It was really very, very knowledgeable. And I would like to again sincere thanks to all the PhD members also, those who have joined here, industry stakeholders, participants, and to spending their valuable time and joining us in this webinar. This was very fruitful, and this was point, I think, Sethi sir, you have very aptly taken up this point today for conducting this webinar. It was his idea to do this webinar. So thank you so much, and IFI to joining together with us in doing this webinar. And I think we look forward for many more informative webinars in going forward. And we'll be in touch with all the speakers. And I think I'll be taking your comments, suggestions, representations, so that we can compile it and we can put it in the right forum to simplify it as well as possible and to make it ease out for all of us, all stakeholders. So thank you so much, and special thanks to Sethi sir and my team who is here, Mr. Sanjay Ahuja, Rajesh ji, everybody here, those who have conducted this and helped us to make it possible and have a wonderful webinar today. Thank you, sir. Thank you. Thank each and every one of you to joining us today in this webinar.
Thank you.
Thank you.
Thank you.
We look forward.
Thank you
We
very
look
much.
forward. Yes.
All of you. Thank you.
Bye-bye.
Bye-bye.